So if you want to trade stocks, for example, you'd look at the New York Stock Exchange or the London Stock Exchange. So those are actual places with physical buildings. But if you want to trade the Forex market, where exactly do you go? So here's the thing, it doesn't really exist. So the Forex market has no physical location and no central exchange. It's just merely existing on the internet. So instead, it's what we call an over-the-counter market or an OTC market. So think of it as a massive invisible web, just like the internet, right? So the entire market is run completely electronically within a global network of major banks, institutions, and it just continues operating continuously over and over again over a 24-hour period. And trades can happen directly between participants based on reputation, price attractiveness, and the current market conditions. Same analogy or same way you would be buying from your local Forex bureau or exchanging Kenya shillings for South African rand at the airport. So as long as you have a stable internet connection, again, from your home or office or studio, you can plug right into this global matrix and trade the Forex market. Now, if you look closely at this massive global network, right? So you'll notice one thing that is very dominant all across, and this is the US dollar. So if you ever look at chart statistics, you'll see something a bit crazy, that the US dollar is involved in almost 85 or 90% of all Forex transactions. The euro in itself is maybe a distant second at about 39-40%, and the yen is merely maybe 20% there. So again, comparing 85% to 30% to 19%, the USD is definitely dominant here, right? So if the USD is one half of every single major currency pair, and the majors make up 3/4 of all the volume, then we definitely have to pay attention to the US dollar. So then why is the world really obsessed with the US dollar? It's not by accident, right? So the IMF in itself points out that about 62% roughly of the world's official foreign exchange reserves are held in dollars. Central banks across the planet, including yours, also just hold on to the dollars like it's gold. I mean, they also hold on to gold, but they also want to keep dollars in their reserves. Why? This is just because, the US has the largest economy in the world. That one we know for a fact. It's very, very highly liquid in the financial markets. They have a great economy, especially now with Trump in there. I think he's pro the US economy. China is trying to give them a run for their money. There was the talk about BRICS where they were trying to, destabilize the US dollar. But again, the US economy is still quite strong. The financial markets are still quite liquid. We've seen that big rise of, AI stocks, Nvidia being one of them. Elon's SpaceX has just joined the NASDAQ, biggest IPO, I think, in the world. Elon Musk is now a trillionaire. You get the point, right? So largest economy in the world, very highly liquid financial markets, stable political system relatively, and let's be completely honest, it is still the largest superpower in the world. So if Japan wants to buy oil from, let's say, Saudi Arabia, okay, they don't use the yen and they won't use anything else. So oil is priced globally in dollars, and this is something commonly known as the petrodollar. Japan has to sell its yen, buy USD, and use those dollars to pay for the oil. So the entire world does transactions in this way, until very recently, where there are some countries that are dealing directly with some oil supplying countries, and they're using alternative currencies. But again, it's yet to shift the global status quo. So now let's tie this back to why we are actually here. Formally, the Forex market exists to facilitate international trade and provide short-term, credit or business credit. So whenever Kenya is taking a loan from anywhere, we're given that loan in dollars and we pay back in dollars. But if we look at the actual daily trading volume, commercial trade is just a tiny drop in the bucket, which is very surprising because over 90% of the volume in this market comes from one thing: speculation. Underline that word, speculation. So then that means that the vast majority of all that multi-trillion dollar liquidity is driven by traders just like you and me, buying and selling based on short-term price movements. Interesting, right? For a short-term trader, this is where our ultimate edge kind of comes in. So because the volume driven by speculators is so high, market liquidity is off the charts, right? So high liquidity means you can enter and exit the market with massive positions instantly with almost maybe zero impact on the market price. And also importantly, you don't get stuck in trades, right? You don't get manipulated by low volume anomalies. But also remember, depth of the market can shift depending, right? So market depth will shift depending on the time of day, again, which is where we covered previously on sessions, and also depending on what financial centers are awake. So is London awake? Is it a Tokyo session or Sydney session? Or are we in the New York session? Okay. So we'll break down all these specific trading sessions a little bit later in the series. So please do hit that subscribe button, turn on post notification bell so that you don't miss out on any fresh uploads. For now, just remember this, right? You don't need a central exchange on Wall Street to make money. You just need to understand how markets move around the power of the US dollar. That's it. That's why in the very recent years, everyone's talking about what Trump is doing, what Trump is saying, because all these things affect the US economy and in turn, in extension, affect the US dollar. And if the US dollar is affected, then us as traders, we need to be very keen on what we're doing in the markets. In the next chapter, again, we're going to look at the different ways you can actually participate in this market as a retail trader. Hit subscribe again. I'll see you in the next video.